Happy Friday, everyone, and welcome to episode 7 of Modern Investing Techniques. I'm Patrick, coming to you from Vancouver on this last trading day of the week, March 27th, 2026. Over the past 5 sessions, we've seen some of the sharpest moves driven by geopolitical headlines in quite a while. So today we're going to do a proper weekly review, talk about how to filter out the noise, review our simulated practice position, look at platform tools that actually help in these environments, and leave you with practical steps you can use in your own TFSA or RRSP next week. Before we dive in, the usual important reminder: everything we discuss on this show is strictly for education and entertainment purposes. The practice investment of the day uses completely simulated trades with zero real money at risk. I am not a licensed financial advisor, and nothing you hear here constitutes financial advice, investment recommendations, or a solicitation to buy or sell any security. Markets involve real risk of loss. Always do your own research and consult a qualified financial advisor before putting any of your hard-earned capital to work. Past performance, even in our simulated account, does not predict future results. Let's start with the market action today. Oil prices climbed noticeably after reports that President Trump noted Iran had allowed 10 tankers to pass through the Strait of Hormuz. That single piece of news injected fresh volatility into the entire energy sector. At the same time, North American equities opened lower and stayed under pressure for most of the session. The S&P 500 finished the day at 6,477, down 1.7% on the session. The NASDAQ Composite was hit harder, closing at 21,408, off 2.4%. Here in Canada, the TSX Composite closed at 31,888, down 1.5%. What we're seeing is a classic divergence. Oil moving higher on geopolitical supply concerns while broader equities remain under pressure from risk-off sentiment. The Iran conflict is now approaching the 1-month mark, and every new headline seems to create another wave of sentiment swings. If you hold energy names inside your TFSA or RRSP, this is definitely worth watching closely, but Canadian investors should be careful not to let daily oil price swings override long-term fundamental analysis. Chasing short-term commodity moves inside tax-advantaged accounts has burned many retail investors over the years. While today's headlines are dominated by conflict-driven volatility, let's take a moment to look at a disciplined framework that can help you cut through the noise in exactly these kinds of environments. I call it beyond the headline geopolitical filtering. The core idea is to deliberately separate short-term noise, things like sudden oil spikes, tanker headlines, or war rhetoric, from the long-term fundamental value of the businesses you own. When you see a sector or individual stock jump or drop 3% or more in a single day purely on geopolitical news, the disciplined move is to pause before you act. Pull up 3 specific metrics: the company's free cash flow yield, its revenue growth trends over the past several quarters, and a clear understanding of its competitive moat. You can find this information quickly on Seeking Alpha, your broker's research tab, or even the company's latest investor presentation. This simple pause and check habit keeps you from reacting purely to price action and headlines. Historically, this approach has served investors well during prolonged conflicts. Think back to the Gulf War period or the early stages of the Ukraine invasion. Initial oil spikes and equity sell-offs often faded within 4 to 8 weeks, while companies with strong balance sheets and real earnings power continued to compound. The risk, of course, is filtering too aggressively and missing a genuine structural supply shift that could last years rather than weeks. For most Canadian investors managing a TFSA or RRSP, the practical step is straightforward. The next time you see that 3% or larger geopolitical move, force yourself to spend at least 5 minutes checking those 3 metrics before you adjust any position. Over time, this single habit can dramatically improve your decision quality during uncertain periods. This filtering approach becomes even more critical when liquidity starts to dry up, because that's when hidden costs can quietly destroy returns. Let me paint a realistic picture that actually happened to many traders last week. Imagine you placed a market order to buy an energy ETF the moment the first major Iran headlines hit. Your order filled at $42.15, but when you looked at the closing price that same day, the ETF finished at only $41.98. The bid-ask spread had blown out from its normal 3 cents to 22 cents within the first 45 minutes of trading. Market makers pulled liquidity fast amid the uncertainty, and that invisible slippage cost you roughly $50 on a $10,000 position. During geopolitical stress, spreads on many TSX-listed energy names can jump 4 to 7 times their normal levels. Professional traders always check both the bid-ask spread and the order book depth before hitting the market order button. This is especially true in the first 90 minutes after major news breaks. The biggest mistake retail investors make is assuming the last quoted price they see is the price they will actually get. Instead, use limit orders set somewhere between the current bid and ask when spreads are wider than 10 cents, or temporarily switch to larger, more liquid ETFs during these volatile stretches. These are small habits that protect capital when emotions are running high. With those costly but valuable lessons in mind, let's move to our practice investment of the day. Remember, this is a simulated trade used purely for educational purposes. No real money is involved. This week, his weekly hold is Western Digital Corp, WDC, on the NASDAQ. The strategy here is a fundamental growth play centered on cloud-driven revenue and margin expansion inside a still volatile memory sector. Recent analysis has clearly identified cloud spending as the primary driver for both top-line growth and margin improvement at Western Digital. Technically, the stock is currently trading near its 50-day moving average after a recent dip, which offers a reasonable risk-reward setup for a weekly hold. We'll be watching for volume confirmation, specifically volume moving above the 20-day average, on any bounce from that support area. On the risk side, further escalation in the Middle East conflict could pressure overall technology spending and delay corporate cloud budgets. To manage that risk, we have a mental stop loss set at 6% below our entry point to limit drawdown on the simulated position. Our target range for this weekly hold is between 4% and 9% by Friday's close. I'm assigning this idea a medium confidence level. The cloud growth narrative gives us a clear fundamental tailwind, but sector-wide memory weakness combined with ongoing geopolitical risk creates real offsetting uncertainty. The purpose of featuring this simulated position is to demonstrate how to anchor a weekly hold in a specific fundamental driver rather than chasing pure price momentum. It teaches you to separate company-specific positives from macro noise. Regardless of how this trade ultimately plays out, the discipline of defining both an exit range and a maximum loss before you enter any position is one of the best ways to protect capital inside your TFSA or RRSP over the long term. We'll track this simulated position through next week and evaluate it on Friday's show. Before we close out the week, let's quickly review yesterday's simulated trade results so we can learn from it in real time. Yesterday's weekly hold was SoFi Technologies, SoFi. We entered the simulated position at $17.16 on Monday's open. By the end of the week, it had closed at $15.87, producing a loss of 7.49%. On a simulated $1,000 position, that equals a loss of $74.91. Our running total across the two simulated trades now stands at minus $74.91. The win rate sits at 0 wins out of 2 trades. The short interest thesis we were following simply did not overcome the broader market pressure last week. This outcome highlights the importance of requiring both elevated short interest and a clear technical catalyst before taking mean reversion setups. Examples of that catalyst would be an RSI reading below 30 or a positive volume inflection on the daily chart. We will be tightening those combined criteria for any future setups of this type. Even with these early simulated losses, I remain convinced that modern tools and disciplined processes can still give individual investors a real edge. Speaking of tools, let's look at 2 platforms that I believe are especially useful right now. First is Seeking Alpha Premium. The depth of its article library and earnings call transcript collection allows you to filter specifically by themes such as cloud growth or memory stocks. You also get access to full earnings call presentations and detailed analyst deep dives that often surface fundamental drivers months before they become consensus. This is particularly useful when geopolitical noise is dominating the headlines. The free tier offers limited access, but premium costs approximately $239 per year and unlocks unlimited articles, transcripts, and their proprietary quant ratings. It's an excellent resource for anyone managing their own TFSA or RRSP who wants to move beyond simple index fund investing. The second platform worth considering is Interactive Broker's Portfolio Analyst tool. Their free geopolitical overlay feature now lets you stress test your entire portfolio against various oil price scenarios and regional conflict variables. You can upload your TFSA or RRSP holdings and instantly see estimated correlations and drawdown projections under different Iran-related outcomes. This help As you quantify exactly how much energy or technology exposure you can comfortably carry without losing sleep. Best of all, it's available at no extra cost to IBKR clients and works on both web and mobile platforms. I have no financial relationship with either of these companies. I simply find them genuinely useful in the current environment. Finally, here are 4 quick hits that caught my attention today and deserve a bit more context. JP Morgan recently highlighted significant upside potential in European defense stocks and flagged its top pick in the sector. For globally diversified Canadian investors, this could represent a sensible sector rotation opportunity outside of North American markets. Reviewing European defense names that also sport strong balance sheets may act as a partial hedge against prolonged geopolitical tension. Citizens Financial reiterated its positive rating on Shopify, citing continued momentum in the enterprise segment. This is encouraging for Canadian investors because Shopify remains one of the few genuine Canadian growth compounders. It suggests the company is still a core holding candidate for growth-oriented TFSA portfolios, even while broader markets are weak. Taiwan made the notable decision to keep power prices unchanged despite the Middle East conflict. That move removes a key cost risk for global semiconductor supply chains and supports taking a more measured approach to memory and chip stocks rather than panic selling on every new Iran headline. Finally, Bank of America expects further US dollar strength through the second quarter. For Canadian investors, this is a reminder that keeping some USD cash or USD-denominated assets inside RRSP or FHSA accounts could help hedge against further loonie weakness if that forecast materializes. Let's take a moment to look at the overall simulated portfolio performance. We have now completed 2 weekly holds. The win rate stands at 0% with 0 wins, 1 loss, and 1 break-even trade. Cumulative profit and loss sits at minus $74.91. The average return per trade is negative 3.75%, and our current streak is 1 loss. Our AI analysis is actively learning from these patterns and adjusting the entry criteria accordingly. This remains a learning journey, not a track record to follow blindly. The goal is to help you develop better processes, not to copy any specific trade. Before we wrap up, keep a close eye on how cloud-related names hold up into next week given the ongoing geopolitical backdrop. That sector strength, or lack of it, will tell us a lot about whether the market is differentiating between short-term noise and longer-term structural growth. That's it. For today's episode of Modern Investing Techniques, you'll find links to all the resources, platforms, and metrics we discussed on the resources page at the website. If you're finding value in these episodes, please subscribe, leave a review, and share the show with someone else who wants to go beyond simple index fund investing. Thank you for spending part of your Friday with me. Stay disciplined, stay patient, and I'll see you back here on Monday. End of episode. This podcast is curated by Patrick, but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content, and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.